pay off my home early? It's a common question among proactive savers and investors. And here today to weigh the pros and cons and discuss the debate is John Kuykendall, founder of GulfCoast Financial Services. Now, GulfCoast Financial Services serves as a resource for North Central Florida savers and investors. In fact, they've been named best of the best in financial services 9 straight years and running by the readers of the Lake City Reporter. John, we always appreciate your time here on the program. This is a big financial decision, and I suppose there are a few different ways to look at it, but I certainly feel like being debt-free as you enter into retirement is a good position to be in.
Well, Peter, I think it's a good position to be in if you can do it. The problem is that, I have a lot of clients that come in and say that my mother and father paid off their house and I want to go into retirement debt free and pay my house off. Well, mama's house didn't cost what our houses cost today. And that's a lot of money to take out of your retirement savings and pay off a home with $300,000 or $400,000 and have that money sitting there and not earning anything for you. I think that people, and I know that Dave Ramsey's a big proponent of paying off your home, but I think to have that much money not earning interest on me and not being able to arbitrage
Yes,
because of low interest rates.
But Dave also does put that in the order of operations. If we're quoting kind of the letter of the law of Ramsey here, John, he puts that in the order of operations after saving 15% for retirement and even after helping fund the kids' college, right? So he's a big proponent of being debt-free, but I think he puts that later on in the baby step order of operations.
Well, Peter, if I could put 15% for savings up, pay off all my bills every month, and then still save money to pay my house off, I probably wouldn't be doing anything because I wouldn't have any extra money. So I'm a proponent of it. The good Lord only gives us one life. And I think we have to enjoy that within reason. And so while we're young and we have kids and we want to go on vacation, we want to do things for them, I think we should do that. I don't think we should be so involved in savings that we put our present life on hold while I wait to save to pay my house off.
John, does the source of the funds matter that we would consider this with? Because I did note that you also mentioned if we're pulling it out of retirement accounts, that might be something completely different, maybe, than if we had the cash to pay off the house sitting in a bank account, correct?
No, that's correct. I mean, if I've got the extra cash and it's sitting in the bank, then that's a question of how much am I earning on that money and how much am I paying on my interest on my house. And the other thing too is very few of our clients come into retirement having that much cash. A lot, as you know, since we started these 401ks, tremendous amount of our money is tax deferred. And if I pull the money out of that, I'm going to pay taxes on it and have to pay a 20 or 30% of the money I'm pulling out in taxes. And so to me, it just makes us have less in retirement by doing that now. I think it's a question of the individual, but certainly, Peter, I don't believe that everyone should pay their house off.
John, also, would it matter how far along we are in the timeline of our mortgage? Because I know that they state an interest rate. And for many people, we locked in very attractive interest rates. We might be able to earn more than that, sitting money, handing the very money we borrowed back to the same bank. We might be able to now earn more than what our stated interest rate is on the mortgage. But isn't that if we keep the mortgage through the duration of the term, where very few people actually do that? I mean, banks don't come around every 5 to 8 years and offer to refinance us for a lower monthly payment out of the goodness of their heart. They know that they are making more money because they start that amortization schedule over again, and we pay mostly interest in the first several years.
Well, that's right, Peter. And what they're going to do is come around when the interest rates are up because everyone wants you to get out of that low interest rate and go into a higher interest rate. Certainly, no one's going to come and say, hey, you're at 4, let me lower your rate to 2. I mean, it just doesn't happen. That's not human nature. But, the thing is that if I have the money to pay it off, and if it's not going to affect my retirement, then certainly we should do that. But I think every person's situation is different. And Peter, it's a lot of money to have sitting on the sidelines, not earning us anything, or being able, as you said, or as I said earlier, to arbitrage between what I can earn outside versus what I'm paying the bank. Now, if I'm paying the bank a higher rate, one of the things that we encourage people to do, if you got a 30-year loan and you make one extra payment a year, you're going to lower that to a 20-year loan.
That it cuts a lot of time off the backside, and those extra payments, John, you do need to make sure that those are going to principal, right? Isn't that something that
Principal.
you have to specify as you are making them?
Yes, but on most loan forms, it'll say principal payment, and then it'll say additional principal. And so you can just put on there whatever your mortgage payment is, and you can lower that. And I encourage all of our clients, if they can afford it, to do 15-year loans, because we're going to pay less interest over 15 than we would 30. And in many cases, the mortgage payment isn't that much more.
I've
But
also
certainly,
heard that the average length that somebody actually keeps their mortgage is much shorter than that, and I think that's because people move or refinance along the way.
yeah, I think what happens is during life, as we're changing jobs and we're going through our life cycle, we naturally move more than our parents did. And so every 5 or 6 years, we're going to be moving to a new place, getting a new home, and we're starting all over. And that's one reason that we aren't able to pay these off by the time we retire. Certainly later in life, we're going to be more set, more stable. And as we get ready into retirement, we may downsize and sell our house, but at the same time, still have to have a mortgage on the new condominium or the new house.
Well, even though it's smaller, when we get to that phase, John, we are looking for permanency, right? We want this to be our
Yeah.
forever home that we age in place in. So maybe we want the latest, greatest, newest kind of features. And even if we downsize, we might up price and end up not netting kind of the equity that we may have expected as a windfall. John, I know, and this is stats from a couple years ago, but from 2021 to 2022, home equity lines of credit, HELOCs, went up 41%. Would you view the HELOC as being any different in this conversation than the primary mortgage itself?
No, the thing we have to be more careful with the HELOCs is that those are going to be adjustable rates. They could be adjustable rates. They could be loans that aren't going to be as long as the regular mortgage. So we need to be careful. We've had several clients who started out at 3-4% on their HELOC, and now they're 7 or 8. And we're encouraging them to pay those off as they can. One of the problems is when we get into retirement and the majority of our money is in deferred accounts, we've got to worry about how much we're paying for Social Security on our Social Security taxes, and then also worry about our Medicare taxes. So it's a never-ending battle, Peter, of weighing all this out. And that's one thing that we try to do when we do our income planning, is sit down and look at how we're going to pay for all this and how's it going to affect us tax-wise.
Yeah. Well, as you mentioned, John, we also want to live life along the way, right? Is that we've got to
Yeah.
enjoy some of our money there. And if we are saving 15% toward retirement, or maybe already retired, and we've done what we need to do to get there, now is the time to enjoy some of the money. Perhaps mentally, emotionally, psychologically, being debt free is a quality that would allow us to enjoy a greater degree of confidence in life. But we also have to work that in with the mathematical side of, does taking a large chunk out to pay off the mortgage mathematically make sense? That's part of the process. You walk through that with your clients there,
Yeah.
right?
Yeah, Peter, that's part of our process when we do income planning. But the thing we have to remember, Peter, is these mortgages or these houses are worth a lot more than they used to be. And your home could be as much as a half, 3/4 of your net worth. And
Sure.
so we don't want to, pay that off and have that jeopardize our retirement. We're living longer, we're doing more, we're hopefully enjoying ourselves. And so we want to make sure that we got enough money to do that. But, we can always sell the house and move into something smaller. But I don't want us to not take advantage of what's going on around us while we're still able.
Yeah. I mean, John, you have a paid off home, right? Whose money is it?
Yeah,
It's yours, right? But
it's
if you
yours.
need any of that money, you got to go to the bank and ask them to borrow it. Their question is, well, how do you plan on paying us back? So it's a matter of liquidity, and liquidity equals in certain cases with certain dollars, opportunity and flexibility. And if we've got the paid off house, again, fantastic, and we should pat ourselves on the back for that. But it may be a question of whether or not we've weighed all the pros and cons of both sides of the equation if we are considering taking liquid assets and paying off the mortgage.
Yeah, Peter, it's like the people who tell me that when they retire, they're going to continue to work, and that's going to supplement their income. Well, we can continue to work as long as we're able to work. But, we may not be able to go to the bank and get that loan to get that money out of the house once we've paid it off and put the money in it. I always think back to the individual who paid his house off and then incurred, not through his own, but through some debt, medical bills, incurred a $20,000, $30,000 credit card bill. We went to the bank to borrow a little bit of money on a $300,000 house, and they turned us down because we had an extra, because he had so much credit card debt. But the credit card company had raised the interest rates to 28%, and we couldn't get him out of it. It was so frustrating to know that he had all that equity in the house, but not able to get money and to pay off those high credit card bills.
People retiring and continuing to work in the words of the great Inigo Montoya from The Princess Bride. I'm not sure that word means what you think it means, right?
Yeah.
John, one kind of twist to this conversation and debate. Renting throughout retirement versus actually buying and owning a home. To me, yes, there is, again, some freedom and flexibility when it comes to renting, that you're not tied to the permanency of buying and owning a home. However, it's also going to be much more impacted by inflation, likely, over the course of retirement than a fixed mortgage payment, correct?
Well, that's right, Peter. I mean, the thing we have to worry about is the rising interest cost, or the rent payments, as the insurance on casualty insurance on the homes go up, as they have to do repairs, certain things. The other thing too you have to remember is privacy. Are you going to be renting a condo, or are you going to be renting a duplex? Who your neighbor's going to be? You can't control that. You can't control how fast they repair the refrigerator or the leak. You've got a lot of frustrations. But as you said, it's also simpler and cheaper probably to rent in the beginning, but it may not be in the end.
John, I know that you and your team there at GulfCoast Financial Services work through high level and detailed investment allocation questions and analysis from an income and a tax standpoint. But are these kind of questions, paying off the mortgage, renting or buying, how to work that into the plan, are these kind of questions also issues that you commonly help clients address?
Well, yeah, Peter. I mean, we have to, when people talk about retirement, we want to make sure that we look at all aspects: Social Security, Medicare, taxes, how we're going to take the money out of their accounts, how we're doing asset allocation. It's a way that we do income planning to make sure that we have done everything we can to make their lives easier and explain to them what they're facing as much as we can in retirement.
Well, ladies and gentlemen, if you would like a resource to bounce ideas off of, to ask these kind of questions, to get into the minutia and the details of planning, to look at a high level or down into a microscopic level of the risks that you're taking, the fees that you're paying, the taxes that you may be liable for, the income that you can generate, and how to do so throughout retirement. That is what the financially focused written retirement income plan is all about, available there at Gulf Coast Financial Services, and for you on a complimentary, no cost, no obligation basis. John and the team willing to have a strategy session, a conversation about your situation and how to work the plan to achieve your goals moving forward. So pick up the phone and give a call, 386-755-9018. That is 386-755-9018. 386-755-9018. 9018, or you can always visit online, GulfCoastFinancial.net, GulfCoastFinancial.net. John, always appreciate the time.
Thank you, Peter. It's great to be here. Have a good week. Hey, if you'd like a copy of our new book, Quitting is for Winners, but Retirement's Not for Wimps, I encourage you to click the link below and get your copy today. Hey, we like it when you listen to the show, but we like it better when you like, share, subscribe, or feel free to leave a comment.
Be sure to like, subscribe, share, and tune in for more financial focus by visiting GulfCoastFinancial.net. The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes. John Kuykendall is registered with and securities are offered through Kovac Securities Inc., member FINRA SIPC, found online at www.kovacsecurities.com. Advisory services are offered through GulfCoast Financial Services Inc., a registered investment advisor in Florida. GulfCoast Financial Services Inc. is not affiliated with Kovac Securities Inc. or Kovac Advisors Inc. Past performance is not indicative of future results. All investing involves risk. Investment decisions should be based on your own goals, time horizon, and tolerance for risk. Due to various factors, including changing market conditions and/or applicable laws, the content may no longer be reflective of current opinions or positions.